All right, so, you've seen the headlines. The markets are just on fire, hitting record highs. But is there this nagging feeling, right? Like it could all just come crashing down, especially when big tech reports their earnings next week.
Well, you are in the right place because in this deep dive, we are going to break down what's really going on in the US stock market and, more importantly, what it means for you.
That's right. We're going to just completely unpack the data, the trends, the expert opinions, so you can really make informed decisions, whether you're a seasoned investor or just starting out,
Okay, let's set the scene a little bit. The S&P 500 is up over 20% this year.
which is fantastic.
Yeah, it sounds amazing, but it also, makes some people nervous. Like, how long can this party keep going?
It's interesting, we are seeing this record performance alongside some pretty significant headwinds. The Fed just cut rates again, which was expected, but it's making everyone wonder what's next. Yeah, the Fed is like that mysterious relative who shows up at family gatherings and you're never quite sure what they're going to do. But seriously, what's the expert take on the Fed's moves?
Well, the 10-year Treasury yield has actually climbed above 4.2%, which suggests the market might be thinking that the Fed won't cut rates as aggressively as some initially thought.
Interesting.
It's like the market is saying, hey, Fed, the economy might not be as weak as we thought.
Interesting. It's like they're playing a game of chicken, and we're all just trying to figure out who's going to blink first.
Okay, but let's talk about the big elephant in the room, big tech earnings. These Dream 7 stocks, as they're called, have basically been carrying the market on their backs.
They really have.
What happens if they stumble?
It's a valid concern. These seven companies, Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, and NVIDIA, have been responsible for a huge chunk of the market's growth. Analysts are predicting they'll report 19% earnings growth, while the rest of the S&P 500 is expected to be flat or even negative.
Wow, that's a huge gap.
It is. It makes you wonder if the market's putting too many eggs in one basket.
Right.
But instead of just freaking out, let's dig a little deeper into these Dream Sevens. What are the key factors to watch for in their earnings reports?
Beyond just the headline numbers, I'll be paying close attention to their forward guidance.
Okay.
What are they saying about the coming quarters? Are they seeing any cracks in their growth stories? That'll give us clues about their confidence levels, not just for their own businesses, but potentially for the overall economy.
Okay, so we're not just looking at past performance, but also trying to read the tea leaves for the future. But let's get specific. What about Apple? Everyone's obsessed with the new iPhone, but is that enough to keep them growing at this pace?
Well, Apple's success is heavily tied to iPhone sales, and there are concerns about slowing demand, especially in China.
Yeah.
So I'll be watching closely to see how they're navigating that. And don't forget about their services business, Apple Music, iCloud, etc.
Right.
That's a growing part of their revenue, and it'll be interesting to see if they can maintain that momentum.
So even within the Dream 7, there are different dynamics at play. It's not just a monolithic tech blob. But what about Amazon? They seem to have their fingers in every pie these days.
Amazon is fascinating because they are so diversified. They've got e-commerce, cloud computing, advertising, and even grocery stores. But their cloud business, AWS, is the real profit driver.
Hmm.
If there are any signs of weakness there, that could raise red flags for the entire tech sector.
See, this is what I love about these deep dives, where you're getting past the headlines and really unpacking what makes these companies tick. But before we get too lost in the Dream 7 world, let's zoom out for a second. We've had 6 straight weeks of market gains.
That's a pretty long streak.
That's a pretty long winning streak.
Yeah.
Does history tell us anything about what might happen next?
Historically, such prolonged periods of gains often make investors nervous about a potential correction. It's like that feeling when you're walking on a tightrope, the higher you go, the scarier it gets.
Exactly. And to make things even more interesting, the source material mentions a couple of technical indicators: a wedge pattern and a MACD buy signal.
Uh-huh.
What in the world does that mean?
Don't worry, I'll break it down for you. A wedge pattern is a chart formation that shows prices converging like a narrowing triangle. When the price breaks out of that wedge, it often signals a continuation of the trend.
Okay, so in this case, the S&P 500 broke out of the wedge to the upside, which is bullish.
Yeah.
But what about this MACD thing?
The MACD is a momentum indicator that helps traders identify potential buy and sell signals. In this case, the MACD triggered a buy signal, which reinforces the bullish sentiment from the wedge breakout.
So we've got these technical indicators flashing green lights. But like you said earlier, there's always that potential for a correction. How do we reconcile these seemingly conflicting signals?
That's the million-dollar question, isn't it? Technical indicators can be helpful, but they're not foolproof. The market's reaction to big tech earnings could easily overshadow these positive signals. It's like being on a sailboat in choppy waters. You can use your compass and charts, but you also have to be prepared for unexpected gusts of wind.
Love that analogy. It's a good reminder that the market can be unpredictable. But speaking of unpredictable, let's talk about the divide between these Dream 7 companies and the rest of the market. Why are analysts so bullish on big tech, but less optimistic about other sectors?
It's a fascinating question, and it really highlights the complexity of the current market environment. Several factors are weighing down other sectors, particularly smaller companies. We're seeing weaker consumer demand, especially among lower income groups, and the effects of the Fed's tight monetary policy are still being felt.
It sounds like a perfect storm of challenges, but are the Dream 7 just immune to these pressures?
Not necessarily immune, but they're definitely better positioned to weather the storm. Their global reach, diversified revenue streams, and sheer size give them a level of resilience that many smaller companies simply don't have. It's like the difference between a speedboat and a cruise ship. The speedboat might be quicker and more agile, but the cruise ship can handle rougher seas.
That makes a lot of sense. But this begs the question, is the market putting too much faith in big tech's ability to carry the entire U.S. economy?
That's a crucial question we'll explore more deeply in the next part of our deep dive.
All right, listeners, we've covered a lot of ground in this first part. We looked at the market's record highs, the looming uncertainty around big tech earnings, and some key technical indicators. We've also started to unpack the reasons behind the stark divide between big tech and the rest of the market.
So before we move on, we'd love to hear your thoughts. What's standing out to you from our discussion so far?
We'll be back in just a moment to continue our deep dive. Don't go anywhere.
Welcome back to our deep dive into the U.S. stock market. I'm curious, did anything from our last segment particularly resonate with you?
Yeah, for me, it's that image of the market being like a sailboat in choppy waters. We've got these positive technical indicators, but big tech earnings could easily change the course of the market.
Yeah, it's a great analogy, and it emphasizes why it's so important to have a balanced portfolio and a long-term investment strategy, even when things feel a bit turbulent.
Right, because even if the Dream 7 stumble, there could be other opportunities out there. We briefly mentioned healthcare earlier. What's the story there?
While the broader market is facing headwinds, some areas of healthcare are demonstrating resilience, particularly those focused on innovation. We're seeing exciting developments in gene therapy, personalized medicine, and telehealth. These advancements are attracting investor interest and driving growth, even in a somewhat uncertain economic environment.
So it's like the healthcare sector is writing its own success story, independent of the big tech narrative. Are there any specific companies you're keeping an eye on?
One company that comes to mind is Teladoc, a leader in telehealth. They're making healthcare more accessible and convenient, which is a huge trend, especially as the population ages. Another interesting company is CRISPR Therapeutics. They're at the forefront of gene editing technology, which has the potential to revolutionize how we treat diseases.
So there's a lot happening beneath the surface of the market. It's easy to get caught up in the big tech drama, but these other sectors deserve attention too. But let's go back to big tech for a moment. We talked about their forward guidance being a key factor to watch. What are some specific examples of what we should listen for?
Let's take Microsoft. They're heavily invested in cloud computing, and their Azure platform is a major competitor to Amazon's AWS. If Microsoft starts to signal slower growth in their cloud business, that could be a warning sign for Amazon and potentially for the entire cloud computing sector.
That makes sense. It's like they're canaries in a coal mine. Their performance can give us clues about the health of the broader tech industry. What about Tesla? They've been on a roller coaster ride lately.
Tesla is an interesting case because their stock price is so heavily influenced by, Elon Musk's personality and pronouncements.
Right.
Investors will be scrutinizing their production numbers, but they'll also be listening closely to what Musk has to say about their future plans, especially their progress on self-driving technology.
So it's not just about the numbers, but also about the narrative, the story that these companies are telling. Okay, but let's not forget about the other big player in this drama, the Federal Reserve. We talked earlier about how the market might be reassessing the Fed's future moves. What should we be watching for in terms of Fed signals?
The Fed's next policy meeting is in December, and they'll release their updated economic projections.
Okay.
We'll be watching to see if they signal any changes to their interest rate outlook. Are they leaning towards further rate cuts, or do they see the economy as strong enough to hold steady?
So it's a bit of a waiting game. But we're not just sitting on our hands. The source material mentions something about stock buybacks resuming at the end of the month. Can you remind us what that's all about?
Absolutely. Stock buybacks are when a company uses its own cash to buy back shares of its stock.
Okay.
This reduces the number of shares outstanding, which can boost earnings per share and potentially drive up the stock price. The source material estimates that companies will inject about $60 billion into the market through buybacks by the end of the year.
That's a significant amount of money. Could that help offset some of the potential volatility from big tech earnings?
It's certainly possible. Buybacks can provide a floor under the market, especially if investors are feeling nervous. But it's important to remember that buybacks aren't a magic bullet. Their impact can vary depending on market conditions and investor sentiment.
Okay, so there are a lot of moving parts here. We've got big tech earnings, the Fed's next move, stock buybacks, and don't forget those persistent geopolitical risks. It's enough to make your head spin.
It's true, the market is complex and unpredictable, but that's what makes it so fascinating. It's like a giant puzzle, and we're trying to piece together the clues to figure out what the picture will look like.
And that's what these deep dives are all about, right? Helping us understand the forces shaping the market and equipping us with the knowledge we need to make informed decisions.
Exactly. Knowledge is power, especially in the world of investing. But even with all the knowledge in the world, we can't predict the future with certainty. There will always be surprises.
Well, that's reassuring. I was starting to feel like I needed a crystal ball to navigate all this. But speaking of surprises, what about those contrarian indicators you mentioned earlier? What are those all about? Okay, so we're back for the final part of our deep dive into the U.S. stock market outlook. It's been quite a journey so far, wouldn't you say?
It certainly has, We've explored the market's record highs and then, of course, that looming uncertainty of big tech earnings. And, we delved into sectors demonstrating strength even amidst all this volatility.
Right, and we've also, examined those fascinating technical indicators like the wedge pattern and Mammoth buy signal. And then along with that, the potential impact of stock buybacks and the Fed's upcoming decisions. Phew, it's a lot to consider.
It is indeed. But as we wrap up our deep dive, let's try to bring it all together and offer some concluding thoughts on what this all means for you, the listener, as an investor, or even someone just simply intrigued by the financial markets.
Yeah, okay. So I guess what are the key takeaways from our exploration? I mean, what should our listeners really be walking away with?
Well, I think the first takeaway is that while the market is enjoying a period of robust growth, there are signs of fragility kind of, lurking beneath the surface. We're at a point where several factors could shift the market's trajectory, and big tech earnings being a major one.
It's like we're walking a tightrope with a safety net below, but still a bit unnerving, right?
A little bit.
So I guess that brings us to big tech's performance as being our second takeaway, right? I
Yeah.
mean, their earnings and guidance will have a ripple effect on the entire market, I would think.
Precisely. Their performance can be viewed as a barometer for the overall health of the tech sector and even the broader economy. Pay close attention to their outlooks for the coming quarters. Any hints of caution or downward revisions could signal a change in tide.
So we're watching for both the what, the actual earnings numbers, and then also the why, their interpretations of future trends. But amidst this big tech focus, it's important to remember takeaway number 3. There are opportunities beyond just those tech giants.
Absolutely. We discussed, healthcare's resilience and those exciting advancements that are really attracting investors there. So don't limit yourself to the headlines. Explore those various sectors and consider diversifying your portfolio.
Diversification is key, right? It's like that old saying, don't put all your eggs in one basket. Now, even with all this potential volatility on the horizon, there's takeaway number 4. The long-term outlook for the U.S. economy and stock market remains positive.
Yes. The Fed's actions to stabilize the labor market and the injection of capital through stock buybacks offer reassurance for the long term. It's about maintaining perspective amidst all those short-term fluctuations.
So while the short term might feel like navigating those, choppy waters, the long-term compass still points towards growth. And finally, takeaway number 5 brings us back to those contrarian indicators.
Right. Remember those record-high investor stock allocations. Historically, this exuberance has often foreshadowed a market peak in the short term. It's not a foolproof predictor, but definitely something to keep in mind as we observe how things unfold.
So it's like a little yellow flag reminding us to proceed with caution, even when everyone seems overly optimistic.
Okay, well, we've covered a lot of ground, and I think we have our 5 key takeaways. But as we wrap up this deep dive, I keep coming back to that question. What does it all mean for me, the individual investor? Yeah, that's the question every investor grapples with. And while there's no one-size-fits-all answer, the insights from this deep dive should empower you to make more informed decisions. Understand those risks and opportunities, be prepared for potential volatility, and remember that diversification and a long-term perspective are your allies.
Yeah, solid advice. It's about using knowledge to navigate the market's complexities and ultimately achieve your personal financial goals.
Exactly. And remember, the market is constantly evolving. Stay informed, be adaptable, and never stop learning.
Couldn't have said it better myself.
Mm-hmm.
Thank you for joining us on this deep dive into the U.S. stock market. We hope it's given you a clearer understanding of the forces at play and equipped you to navigate the exciting yet sometimes unpredictable world of investing. Until next time, happy investing.